China's economy is facing a serious test as billions of dollars are flowing out of the country, often illegally. This surge in capital flight is a response to a faltering property market and broader economic uncertainties. But this isn't just a domestic concern for China. The massive outflows reflect deeper vulnerabilities and declining confidence in China's future. As more wealth escapes the country, it places growing pressure on US-China relations, raising stakes in economic and geopolitical competition. In this video, we'll explore how these shifts could reshape global power dynamics, from trade conflicts to financial markets, and what it all means for the United States. Over the past year, Chinese residents have moved an estimated $254 billion out of the country, an astonishing amount considering China's strict capital controls. This surge in outflows is largely driven by deeper economic and structural problems that have been brewing for years. At the heart of this issue is China's once dominant real estate sector, which has undergone a catastrophic collapse. Companies like Evergrande and Country Garden, two of China's largest property developers, have defaulted on billions of dollars in debt, leaving behind incomplete housing projects and millions of Chinese families without homes. Evergrande alone is saddled with over $300 billion in liabilities, and its collapse sent shockwaves through China's financial system. For decades, the real estate sector was a cornerstone of China's economic rise. In fact, the housing market once accounted for nearly 30% of China's GDP, significantly higher than in most other major economies. For many Chinese households, real estate was not just a place to live but the most reliable way to grow wealth. Buying property became essential to family security and even social status, particularly in urban areas. However, as property prices skyrocketed, so did debt levels. Developers took on enormous liabilities to keep pace with demand, often pre-selling homes they could not afford to complete. This speculative bubble was bound to burst, and when it did, it wiped out trillions in household wealth, destabilizing China's economy. The real estate collapse has eroded confidence not just in housing, but in China's broader economic future. Growth projections for China have been slashed, with the IMF now forecasting that growth could fall to just 3% by the end of the decade. This is a sharp decline from the double-digit growth China saw just a decade ago. The once unshakable belief in China's economic miracle has faltered, especially among the wealthy, who are now increasingly looking to move their money abroad. They're doing this despite severe penalties for violating China's capital controls, which restrict individuals from exchanging more than $50,000 of yuan into foreign currencies annually. Wealthy individuals and businesses are employing a variety of methods to move money out of China. Some use traditional approaches like setting up overseas shell companies or investing in foreign real estate. Others are turning to cryptocurrencies, despite China's ban on crypto trading. For instance, residents are ferrying hard drives filled with digital currencies out of the country to convert them into US dollars abroad. These outflows aren't just a reflection of investor pessimism, they represent a potential threat to global markets. Chinese capital is flowing into assets around the world, from real estate in the US and Europe to equities and even fine art. US financial markets, already struggling with high interest rates and inflation, may see more volatility as a result. On the other hand, this exodus could create new opportunities for American businesses, especially in sectors like real estate, where Chinese investment has historically been strong. Ultimately, this wave of capital flight signals deep-rooted issues in China's economic model. The property market collapse, shrinking workforce, and ongoing trade disputes with the US are placing immense pressure on the world's second-largest economy. And while Beijing has rolled out stimulus measures, such as cutting interest rates and easing mortgage restrictions, to stabilize the economy, the impact has been limited so far. Confidence, once lost, is hard to regain, and as we see today, Chinese citizens with means are increasingly deciding that their future lies elsewhere. This accelerating capital flight out of China is not just about money leaving the country, it reflects broader instability and declining confidence in China's economic future. For the US, this exodus signals potential opportunities but also new risks. As China's economy falters, its ability to project power on the global stage may weaken, but paradoxically, this could intensify the competition between the two countries rather than reduce it. Over the past several years, the US has been actively working to decouple its economy from China's, particularly in sensitive sectors like technology and semiconductors. Major policies, such as export controls on advanced chips and investment restrictions, are designed to protect US technological dominance. The US has also sought to shift supply chains away from China, encouraging companies to diversify into other regions like Southeast Asia or even bringing manufacturing back to American soil. This capital flight puts additional pressure on China to retain its investment base while boosting US efforts to lead in critical sectors. One example of this can be seen in the semiconductor industry. Companies like Taiwan's TSMC, which plays a crucial role in global chip production, are increasingly expanding operations closer to the U.S. amid growing geopolitical uncertainty. The U.S. government is also pushing initiatives like the CHIPS Act to accelerate domestic semiconductor manufacturing, further insulating itself from dependence on China. This shift has profound long-term implications, potentially reshaping global supply chains and further isolating China economically. However, the capital flight from China also raises serious security concerns. A weaker Chinese economy, in theory, could limit Beijing's ability to invest in its military and extend its global influence. But history shows us that when economic troubles arise, nations can sometimes become more aggressive externally to distract from internal issues. The U.S. has to prepare for a scenario where China becomes more assertive in key geopolitical flashpoints, particularly in the South China Sea or over Taiwan. Beijing's increased military activities in the South China Sea over the past few years, along with its constant warnings over Taiwan, suggest that economic challenges won't necessarily lead to a retreat but may instead result in more assertive stances. Additionally, if China continues to experience significant capital outflows, it risks further depreciation of the yuan, which could destabilize global financial markets. The U.S. and other Western economies might face increased market volatility as Chinese investors shift capital into safer, more stable markets, such as U.S. real estate or equities. While this inflow of capital could boost certain U.S. sectors, it could also create greater market distortions, making it crucial for American policymakers to manage this transition carefully. Ultimately, what we're witnessing is a moment where the economic and geopolitical competition between the U.S. and China is being reshaped by these financial trends. For the U.S., it's an opportunity to further secure its global economic leadership, but it comes with the risk of increased geopolitical tensions as China navigates this period of uncertainty. But it's not just about geopolitics. Capital flight from China has far-reaching consequences for global financial markets. As Chinese investors move their wealth abroad, it creates ripple effects across sectors, from stocks to real estate and even cryptocurrencies. As Chinese wealth continues to leave the country, the pressure on global financial systems intensifies. U.S. companies, particularly those with deep ties to China, could feel the strain. Firms involved in manufacturing, technology, or supply chains reliant on Chinese exports might face disruptions as China's economy weakens and global investors grow wary. For example, recent months have seen U.S. companies with significant Chinese exposure, like Apple and Tesla, reassessing their strategies to mitigate risks tied to China's downturn. This type of instability can lead to volatility in global stock markets, as investors weigh the broader implications of China's struggles. On the flip side, Chinese capital flight presents new opportunities, especially for U.S. investors. With Chinese wealth seeking safer havens, U.S. assets such as real estate and stocks could see increased demand. For instance, American real estate markets, particularly in cities like New York and Los Angeles, may experience a surge in interest from Chinese investors looking to safeguard their wealth. Cryptocurrencies are also seeing a boost as Chinese investors use them to circumvent capital controls. However, while this influx of capital can stimulate U.S. markets, it can also heighten volatility, especially if capital flows in and out rapidly, causing fluctuations in asset prices and market sentiment. Ultimately, as capital continues to leave China, it will not only reshape Chinese markets but also create waves across global financial systems, with the U.S. at the center of this shift. While the risks are significant, so are the opportunities for investors ready to navigate this new financial landscape. Looking ahead, the U.S. and China will likely continue their competition, but the economic landscape is evolving rapidly. China's capital flight, driven by domestic uncertainties, is just one sign of deeper structural issues, such as a crumbling property market and slowing growth, that could undermine China's global influence. While this may weaken China's position economically, it could also provoke more aggressive foreign policies as the country seeks to compensate for internal instability. For the United States, this period of Chinese economic uncertainty offers a strategic opportunity. By reinforcing key alliances, particularly with countries in the Indo-Pacific like Japan, South Korea, and India, the U.S. can counter China's regional influence. This could also be a moment to draw more businesses out of China, accelerating the decoupling process in sectors like technology and manufacturing. Initiatives such as the CHIPS Act and efforts to reshore supply chains are already underway, bolstering U.S. leadership in critical industries like semiconductors, AI, and clean energy. This shift in global supply chains could redefine the balance of power in high-tech sectors. However, this shift in the economic balance could increase risks for global markets and international stability. China's government might adopt a more aggressive stance abroad to distract from domestic troubles, especially in flashpoints like Taiwan or the South China Sea. This is where the risk lies for the US and its allies. Economic weakness might push China toward military or diplomatic escalation as a way to maintain its strategic leverage. The global financial markets will need to brace for potential instability as tensions rise and as both countries continue to jostle for dominance on the world stage. So, as billions of dollars leave China and the cracks in its economy widen, we're witnessing a major shift in the global financial landscape. The question now is, will the US leverage this moment to strengthen its economic position, or will it face new risks as Chinese capital floods into global markets? What do you think?